I've been a reader since I was a kid, and in the early days of my investing journey, I started with books on dividend investing and dividend growth investing. I was intrigued by the idea of dividends as free money. The concept was simple and appealing, right? You get a small paycheck for doing absolutely nothing other than investing in a handful of stocks. It almost sounded too good to be true, and for a while I thought I had found the secret sauce to easy passive income. And so I invested heavily in dividend stocks. But as I learned more about investing and as I read more books, I realized that a lot of people, like me back then, don't fully understand the math behind dividends and why dividends aren't exactly free money. The idea that dividends are free money first came up when I was talking to my CPA after registering my business through him. He was reviewing my brokerage statement and it was 45 pages long at that time. And he casually mentioned that I might be complicating investing. He gave me a short 5-minute lecture. At that time I didn't fully understand it, but change doesn't happen overnight. It took me a lot more reading and a lot more research to realize that just how wrong my initial views on dividend investing were. In this video, I'm going to break down why, in my opinion, dividend investment is a fundamentally flawed strategy that can limit your financial growth. I'll also explain why I have chosen a different path for my own investments. One of the most common misconceptions about dividends is that they're free money. It's an enticing idea. Invest in a stock, hold it, and receive regular payments for being a shareholder. But here's where the misunderstanding begins. When a company pays a dividend, it's not giving you money on top of your shares value. It's simply redistributing its profits back to you. In fact, the market adjusts the stock price downwards by the exact amount of the dividend paid. So you're not receiving any additional value. You're just getting a portion of your investment returned to you. Imagine you own shares of a company trading at $100 and it declares a $5 dividend. On the ex-dividend date, the share price adjusts to $95. This is because the market knows that the company has paid out $5 per share to its shareholders, reducing the assets by that amount. It's important to understand that the company did not magically create more value. It just shifted money from its balance sheet to your pocket. If you think dividends are free money, you're falling into what's known as a free dividend fallacy. This fallacy makes investors believe that they're gaining something extra, when in reality, they're simply receiving a redistribution of their own capital. It feels good to see a check come in, but the underlying reality is that your wealth hasn't increased. It's just been rearranged. When dividends are paid, the stock price does not drop randomly. It's a deliberate adjustment reflecting the cash outflow from the company. Let's use a real-world example to illustrate this. Recently, Apple paid a dividend of $0.25 per share. Right before the ex-dividend date, the stock price closed at $216.24. After the dividend was paid, the stock adjusted down by 25 cents, reflecting the payout. This adjustment may not be as apparent with all the price movement, but it's there. The same thing happens with ETFs and mutual funds that distribute dividends. Whether they pay a few cents or a few dollars, the underlying asset decreases accordingly. To understand why this happens, we need to think about what dividends represent. Dividends are paid out of the company's profits, which are essentially a part of its retained earnings. When a company distributes these profits, it reduces its cash reserves, meaning it has fewer resources to reinvest in the business. This reduction in cash is reflected in the drop in share price. Some investors might say, well, I don't care about the drop because I'm getting my cash. But the reality is that this cash isn't extra wealth. It's part of what you already owned. A good way to think about this is by comparing it to owning a small business. Imagine you own a coffee shop that makes $10,000 in profits every month. You could decide to take $5,000 of that profit out for yourself as dividend and leave the other $5,000 in the business to reinvest. But if you keep taking out $5,000 every month, eventually the business won't have as much cash to grow. Similarly, dividends can make it seem like you're getting a bonus, but in reality, you're drawing from the business's existing resources. Another misconception is equating dividend income with interest income from bonds or savings accounts. They are fundamentally different. With interest income, you are earning money on top of your initial investment. The principal remains intact and the interest payments are true gains. For instance, if you have a $1,000 bond paying 5% interest, you receive $50 each year, and your original $1,000 investment remains untouched. That $50 is a true return on investment. However, dividends are different. When a company pays you a dividend, it's essentially returning a portion of your equity in the company. It's as if you have $1,000 in the savings account and the bank sends you a $50 check but then reduces your account balance to $950. Does that feel like a gain? It shouldn't, because it's not. This is why dividend income is fundamentally different from interest income. One of the biggest drawbacks of dividend investing is taxes. Dividends are taxable income, and this applies even if you're reinvesting them back into the same stock. In contrast, with a growth-focused investment strategy, you don't incur any taxes until you sell your shares, and even then you can manage how much you sell, giving you more control over your tax liability. To put this into perspective, let's consider two investors, one who relies on dividends and another one who focuses on growth stocks. The dividend investor receives $10,000 in dividends annually. If those dividends are paid into a taxable account, they'll have to pay taxes on the full $10,000. Meanwhile, the growth investor can choose when to sell shares, giving them more flexibility to time their sales for maximum tax efficiency. If you're receiving dividends and reinvesting them, you might think you're compounding your returns, but don't forget you're paying taxes every year on those dividends, eroding your returns over time. It's like taking 2 steps forward but 1 step back. This is why focusing on growth, where you don't pay taxes until you sell, can lead to better long-term results because your money can compound without the constant drag of taxes. This obviously will not apply if you're buying dividend stocks in a Roth IRA. Over the long term, growth stocks tend to outperform dividend stocks because they reinvest their profits to grow their business rather than paying them out. Companies that reinvest profits into research, development, and expansion are often able to increase their earnings and consequently their stock prices. This leads to capital appreciation, which can compound over time. For example, let's do a comparison between VOO, which is a Vanguard S&P 500 ETF, and JEPI, which is a JP Morgan Income ETF. JEPI is very popular amongst young investors these days. Why? Because it has a dividend yield of, I don't know, somewhere around 7 to 8%, and it pays monthly. So young investors love it. There's even a Reddit group on this popular ETF. Now here's the problem though. If you compare the charts, JEPI doesn't just fall short, it falls short by some margin. And mind you, these numbers are adjusted for stock splits and include dividends. Another well-known ETF is SCHD, and I know this might be a controversial take because investors love SCHD, but the numbers speak for themselves. SCHD offers a dividend yield in the 3 to 4% range, which means it's not as much of an underperformer as JEPI. However, it's still trailing by about 20%. And full disclosure, I do own a small position in SCHD, just a small position. Another argument that I often here is that dividend stocks can protect against sequence of returns risk. The idea is that when market crashes, you can live off of your dividends without selling the shares at a loss. But this isn't entirely true. Dividends aren't immune to market downturns, and during major market crashes, many companies cut or eliminate their dividends altogether. Relying on dividends for a steady income stream during these times can be risky. During the financial crisis of 2008-2009, companies like General Electric and many banks were forced to cut their dividends drastically. Even companies that had long histories of consistent dividend payouts had to make the hard decision when their cash flow was disrupted. So if you're counting on dividends to provide stability in a down market, you're taking a gamble. The reality is that dividends can be cut, and when they are cut, it is usually at the worst possible time, during an economic downturn when you need the cash the most. Now, don't get me wrong, I don't hate dividends. In fact, dividends have their place. They can be a great source of income for retirees who need cash flow and aren't as concerned about capital appreciation. They're also great for people who are heading into retirement and want to convert from growth to income. But for me, the math doesn't add up. And I'm also going to say that for most younger investors, the math doesn't add up either. Most of my portfolio is in VOO, which is the Vanguard S&P 500 ETF. That's the majority of my personal portfolio, and I don't plan on changing it anytime soon. If you still love dividends, that's okay, but I hope this video helps you clarify why it might not be the golden ticket some people make it out to be.